Good morning from London. I'm Anna Edwards alongside Guy Johnson and Chrissy Gupta. We're an hour away from the opening trade. Here's what you need to know. French Prime Minister Michel Barnier warns of a moment of truth with his government on the verge of collapse. Fed Governor Christopher Waller says he's leaning towards a US rate cut this month, with other officials making clear they expect more cuts by next year. Plus, China's yuan drops to a one-year low amid worsening economic sentiment in China. This as top leaders plan to meet next week to discuss the country's GDP target and stimulus measures.
In the meantime, a quick check on these markets. Seeing a little bit of positive risk sentiment when you look at the futures picture. Euro Stoxx 50 futures higher by 0.2%. The FTSE 100 right on its heels. But it's the euro that really is interesting to me, as we have this French political overhang, a 104 handle on the currency. Brent crude as well, one eye on the Middle East, 72 handle there. The countdown to the opening trade starts right now.
Tuesday morning, good morning. France firmly in focus. Barnier is warning of a storm if his government collapses. But to borrow from the British, Anna, could this just be a storm in a teacup?
Well, it could be, or it might not be. It's the moment of truth is another thing that Michel Barnier has been saying, and that is indeed the case, it would seem, for the French government. This week, a no-confidence vote, then, looms on the agenda as soon as tomorrow. That's the required amount of time between what we saw passing yesterday and what could happen tomorrow. Le Pen has said that she will back the left in this motion to topple the government. So that's where we are, and markets have responded and will continue to respond. The spread widening yesterday up to the high 80s, 89 basis points, I think, at its peak. A fairly substantial widening move. And actually, as we remarked yesterday, Guy, a big movement in the euro. Chrissy, you've been asking for many weeks, it seems, like, when is this going to stick to the euro? Well, yesterday, it felt as if it was the day where this did stick to the euro, down by 1% in session.
I was going to say, I had a day off yesterday, and my eyes were glued to what was happening in France as well. And I finally felt a little validation that the euro was dropping, only because it felt like such a dislocation for some time. But I'm curious how much. How are people valuing it? If you do get a caretaker government, for example, by the end of the week, is that still a negative for the euro or the French assets? I still don't know.
This is the huge thing. So despite the weather warnings coming out of Barnier, is this actually as big a deal as maybe we're all making it out to be? Yeah. French bonds are higher, so the yields are higher. So that's certainly a cost to France. But it's interesting, there's a Natixis note floating around. We're going to talk to Natixis fairly shortly. The French deficit would theoretically reach 5.3% of GDP next year, if we basically see a continuation of the current 2024 budget into next year, which is what is being postulated, a scenario which is basically quite close to the latest versions of Michel Barnier's budget after his numerous setbacks. I quote from Les Echos.
Right. It does seem as if there's just this is a really good point, but there's also just a lack of clarity and a lack of consensus as to exactly how the process works. And in amongst that, there is room for volatility. Whether we end up finding firm footing, though, is a good question.
The real cost does seem to be to France the higher yields that it's going to have to pay. So the government is going to have to fork out for that. So that's going to be a cost. But what seems to be the story that's evolving is that pensioners are going to be the winner and taxpayers are going to be the losers. Yeah. And the two are basically just going to net out to a budget that looks fairly similar to what was being suggested in terms of 2025.
Although much more austere. That seems to be the other, with this loi spéciale, if they use that to get the budget through for next year, it does mean that we don't have a shutdown like you'd have in the United States. Yeah. But it does mean that spending is stripped right back.
Yeah, but then with maybe minimal changes to the actual economic output, which was the exact point that the S&P ratings agency made around the potential sovereign rating. They didn't even change the outlook. They said, well, the fundamentals kind of remain the same regardless of how this all turns out, which brings us to, I think, the conversation over at the Federal Reserve as well. You mentioned that it's a similar conversation in the United States where they are facing that government shutdown, and that has a very real effect into the U.S. yield picture. Monetary policy, I feel like, making a comeback in terms of narrative. How dare they into the holidays?
I disagree. I don't think it is. I think the markets have barely moved on this.
I agree.
You've got the dollar pretty much where it was. You've got US yields exactly right now. They're exactly where they were yesterday morning, 2-year, front end of the curve. Waller maybe moved things a little bit mid-session, but really we're waiting for the data. We're waiting for jolts today, and in reality, and Waller talks about this, we're waiting for the payrolls on Friday.
Right, yeah, I mean, but are we I suppose so. We are waiting for the data, but are we also just waiting for more, Truth Social posts from President-elect Trump, which is the other thing that is really guiding markets? One of our colleagues Dan pointing out to us that Waller is important because he has been a bit of a signal from the Fed before. And so if this is an attempt pre-Powell, and we're going to hear from Powell tomorrow, I think, aren't we? And certainly midweek. If this is a signal pre-Powell about where the Fed is thinking it will go in December, because it's still pretty up in the air for December.
Yeah, and the quote on our screen right now really talks about the fact that he's supporting his argument by pointing to the labor market. And very quickly, that narrative could change. You are already seeing announcements from around the world, certainly in Europe. We've talked about this a lot in terms of kind of layoffs and restructurings. That has yet to show up in the United States. But the story that caught my eye was the kind of Cargill, the major agricultural kind of trading giant. And the reason is simply because in the United States, so much of those ag producers, John Deere, among others, ag-related, I should say, companies, because Cargill isn't a producer, do tend to have some sort of economic lead in terms of how they see the global economy. So the fact that they're restructuring and the fact that they're laying off about 5% of their global workforce was interesting. I wonder what Christopher Waller would say to that.
Wait for Powell tomorrow. Let's see what he has to say. He might stick it. He might say, you know what, we're not going to do this. We'll just wait. I think we wait for the data as well. And 2025 looks like, who knows. We talked about the dollar just a moment ago. The yuan is at a one-year low. You've got Chinese yields at record lows. This may be reflecting the reality of the data that we are seeing coming out of that economy right now. We are, though, expected to maybe get this meeting next week, I think the 11th and the 12th, and more stimulus being talked about.
Yes, dangled in front of you. It's always on a string, some yards ahead, it would seem, some metres ahead of you. This is what I love about the Chinese economic narrative and the way it's managed, is that when one meeting disappoints, there's always another meeting on the horizon. Because just as I'm reading copy this morning talk about the disappointment, about a lack of stimulus, fear not, there was a red headline telling us there's a Central Economic Work Council meeting takes place next Wednesday and Thursday, and there we will get deliberations over the growth target, over fiscal policy into 2025. We won't hear about those numbers until March. It seems, but the fact that it will be discussed, we'll be reading the tea leaves, we'll be trying to get a sense of where the Chinese government thinks can go.
And that's the economic story. Then, of course, there's the corporate story as well, which is kind of a function of the U.S. foreign policy as well. At least that's moving markets this morning in part. These, again, yet another layer of chip curbs that you're seeing. That's showing up in some of the South Korean chip makers as well. And then also Donald Trump talking a little bit about the Nippon Steel deal. I thought this was interesting, that he's kind of marrying two major contentious points, which is, of course, they're very opposed to U.S. Steel and the potential takeover from a Japanese company, but then also that tariffs could play as kind of a negotiating tactic in the M&A space. That's an overlap I didn't think I'd ever be talking about.
I think there's going to be plenty of these kinds of discussions where it's used tactically. The tariff story is used from a sort of mercantile point of view. That does seem to be the narrative. Very, very transactional. It's going to be interesting to see how ASML opens up this morning, because there is a carve-out for foreign companies. The chip producers, the chip producers are going to be potentially carved out. So the equipment companies could see maybe a bounce this morning. You've certainly seen some evidence of that out in Asia this morning.
And ASML certainly downplaying the impact, weren't they, Tom, telling us, no change in guidance 24 or 25, and no change in their long-term assumptions about the size of this market. So that's significant, perhaps.
Let's talk about what we've got coming up in the show. We've got plenty of great guests coming up. Mabrouk Chetouin, Head of Global Market Strategy at Natixis, is going to be joining us. I reference you back to that Natixis note talking about the 5.3 that we are going to be seeing coming out of France in terms of the budget deficit next year. Luke Bars from Goldman Sachs Asset Management coming up as well. Richard Madden, European Executive Chair at the investment bank DC Advisory, all coming up. We're going to focus on France. We'll talk about the Fed. We'll kind of roll all these stories into these conversations we're going to be having, Critty.
In the meantime, of course, a couple of other things to be watching in the day ahead. About 11:30 a.m. UK time, the Chancellor answering questions in Parliament. And then it really does come back to the French story. I think that's where all eyes are. The French National Assembly will be convening later today, as we discussed. And Salesforce earnings after the market. We talk about big tech a lot. Salesforce, I think, doesn't always have the European read-through, but this will be an interesting one as well in terms of that business investment. And then, of course, Fed speakers Kugler and Goolsbee hitting the wire.
Let's talk about what else you need to know this morning. Running through some of the other big stories. Israel says it, quote, remains obligated to a US-backed ceasefire in Lebanon. This after carrying out airstrikes in the southern part of the country yesterday. The attacks coming in response to Hezbollah's first attack since the truce began. The situation in Gaza also remains in focus, as the US President-elect Donald Trump said in a post on Truth Social. He says that if all the hostages are not released before January the 20th, there will be, quote, all hell to pay in the Middle East. Staying with Donald Trump, the US President-elect has picked investment banker Warren Stevens for the role of UK ambassador. Yesterday, his son-in-law's father, Charles Kushner, was named US ambassador to France. The nominations came as it emerged that Donald Trump is expected to travel to Paris to attend the reopening of the Cathedral of Notre Dame. That was, of course, devastated by a fire back in 2019. And Bloomberg has learned that SpaceX is in discussion to sell insider shares. This would value the company at around $350 billion. That figure would be a significant premium to the previously mulled valuation, which was only, I think, last month, of $255 billion, and will cement Elon Musk's rocket and satellite company as the most valuable private startup in the world. There's another story as well which relates to Tesla, but this story around SpaceX is absolutely incredible. The valuation step up over the course of just a few weeks. Absolutely eye-watering.
$100 billion, is that the value of Elon Musk's relationship with the President of the United States? We've seen it in the Tesla share price, haven't we, to your point, you know, with Tesla, Elon Musk's Tesla Pay also in focus, but the stock, Tesla stock up 42% since the election, so if you translate that into the valuation of, I mean, that's overly simplistic, I'm sure, but there's something of that in there. And if this were a listed business, our colleague Dan Curtis tells me it would be the 24th largest on the S&P, around the same size, actually, market cap as Bank of America.
Oh, I don't know how I feel about that. It's a little fun fact, actually. But I think in the time, speaking of valuations, you talked about this. This is the value of the relationship between Trump and Musk, the bromance, if you will. But I think it's coming at a time as well when we're talking about it in the context of OpenAI as well, right? This idea of startups, this new technology, the valuations are getting really high, and it kind of feels a little bit like 2019 in that maybe some of these valuations are getting.
What happened at What happened at the end of 2019?
Well,
did stocks go down?
No, actually, they went down at the end of January 2020, and that was the COVID story. So there you go, Guy.
Have I just walked into some sort of test situation? this is giving me anxiety.
Guy and I talk a lot about whether stocks always go up. So I think he likes to point out that the corrections happen.
Okay,
and I like
they do
to
occasionally
pretend.
happen.
They do.
I admit they're few and far between, but occasionally they do happen.
They do, and I'd like someone to do some analysis under whether Trump presidency we saw more volatility around periods when markets were closed, because I'm talking of anxiety, getting anxiety about the holiday period. I remember that actually being busier than you would have anticipated under a Trump presidency, but let's see if that stands up to scrutiny. At 7:11 here in London, coming up on the programme, the British Prime Minister Keir Starmer says the UK does not need to trade off its special relationship with the United States against its European allies. It does not have to choose, apparently. We'll bring you more from his keynote speech on foreign policy later in the show. Plus, ASML maintains its net sales forecast for next year, despite the US tightening curbs on China's access to chips and chip-making gear. We'll discuss what the new restrictions mean for the wider semiconductor sector. Up next, we'll talk to Becky Chin, multi-asset portfolio manager at Fidelity Investment Management. We're going to take on French assets, given the news flow, given we're waiting for bond markets to open up at 7:30 UK time. And we'll widen the conversation to take in the Fed and other geographies as well. IB plus BBTV Go, that is, of course, the function to use this morning if you want to get in touch with the team that puts together the programme. This is Bloomberg.
This bill is now here. Now is the time to act to implement it. I believe we've now reached a moment of truth which confronts everyone with their responsibilities. It's now up to you, members of the Parliament of the nation, to decide whether our country adopts responsible financial texts, essential and useful to our fellow citizens.
The current French Prime Minister, Michel Barnier, is saying that his government has reached a, quote, moment of truth. What happens next remains a little uncertain. For more now, we're joined by Bloomberg's Caroline Conan, joining us from Paris. Caroline, who will be the French Prime Minister on Friday?
That's a million-dollar question. And in fact, remember just a few months ago in July, after the snap elections, we were asking the exact same question. Who can be a prime minister in France with no majority in parliament, where you have an alliance of the far left and the socialists, with 1/3 of parliament, a centrist behind Macron, around 1/3 as well. And then the national rally, very powerful. Marine Le Pen, as you know, has become the kingmaker. And she is the one who may actually make Barnier collapse on Wednesday night or Thursday morning with this support that she's already said she's going to bring to France about the far left motion of no confidence against Barnier's government. So clearly we might be on again for a new search of a new prime minister, unless, of course, President Macron decides to resign.
Right. I mean, what happens next if the government is toppled then this week, Caroline? Because reading through a lot of the great writing by our team over the last couple of days, there are lots of different opinions out there as to how exactly the process works, how robust the process is going to be going into next year.
Yeah, in terms of the budget, obviously this budget is not going to be able to pass, at least the way it is at the moment. So the government, the caretaker government of Michel Barnier, who will remain in place until someone else is named as prime minister, will probably have to use some special laws in order to approve some funding month by month, in order to be able to keep collecting taxes and pay the more than 5 million public servants that we have in France. So that means there's not going to be any shutdown like we see, for example, in the US. And that means in terms of the budget, there will probably be a new budget bill discussed in the early weeks of 2025. But again, with what majority, with who as prime minister, that's very uncertain. Is the government or is Emmanuel Macron going to turn to the moderate left, you know, these 66 socialist MPs who could possibly allow for some sort of very uncertain majority in parliament? A lot of uncertainty. And, you know, I was reading from Bloomberg Economics analyst, which is very interesting, saying that, you know, Marine Le Pen is on trial. She's facing a possible ban from running for office in 2027 for the next presidential elections. The verdict is expected at the end of March in this trial on embezzlement of EU public funds. And in the short term, according to Bloomberg Economics, she might actually prefers chaos to stability.
Chaos to stability. We'll see if we do indeed get that. Bloomberg's Caroline Conan, we thank you so much. Breaking down the situation coming for us out of Paris. Let's bring in a little bit of a market perspective here. Becky Chen, multi-asset portfolio manager over at Fidelity, joins us around the table. Becky, you've picked a good day to join us. Chaos instead of stability. Is that what we get in the French markets?
I think chaos is an interesting word, very much reflecting the current situation. If we cast our mind back, I suppose, in the summer, I remember when I was last year, we were also reading about chaos, about politics. I suppose back then when market celebrated the outcome of the parliamentary election, considering that we didn't get majority in far left or far right, and maybe France has escaped a sovereign downgrade, and so market sentiment was quite positive. But then back then I remember chatting with the team and talking about, but it doesn't really make the fiscal situation any easier, any better, and it's probably going to come back and bite investors down the line. And several months down the line, we're seeing exactly that. And so Caroline had highlighted before, this uncertainty is probably going to stay elevated for a while, even if the government doesn't fail on Wednesday. There's 2 more parts of the budget, and the uncertainty can last until at least late December, if not next year, when the parliament may be re-elected. And so it's understandably that French spreads are elevated and probably will remain so in the near term.
So that elevation, there are calls coming for 100 or even surpassing Italian BTP yields, for example. Perhaps a little bit of an exaggeration at this point, but we'll certainly see. I'm curious, just big picture, how much of a kind of systematic risk that is. I mean, I think we talk a lot about, there's a lot of comparisons being made to the kind of the Eurozone debt crisis of 2011. Are we there yet? And what could we be there if, say, we do get to that 100 basis point spread?
I think the spreads at since Eurozone crisis highs is certainly worrying, because it has a feedback loop back to growth and debt trajectory. And I think, as I mentioned before, the debt situation is unlikely to resolve itself as together with the political situation. And the truth is that without a majority in the parliament, it's just difficult to have any sort of meaningful fiscal consolidation in line with the medium-term fiscal plan. However, I do think this is not quite a Eurozone crisis level of systemic risk yet. We've seen periphery yield a diverging trend. And if you look at French yield level, they're still down, even though spreads are up. And so we frequently talk about debt sustainability, quoting R minus G, and the country's nominal growth is still better than the interest rate on the stock of debt. And so it's not yet at a full-blown fiscal crisis and Eurozone crisis mode, I would say, at the moment.
Isn't this just another reason to hide out in America? Why do I want to own European assets?
I would say a lot of investors agrees exactly with you as we see asset performance between US and Europe. We do think in our team, in terms of asset allocation, we've had a preference for US over Europe for much of this year. And a lot of that is not even predicated on political pressure domestically, but just simply earnings trajectory is a lot stronger in the US. I think there are probably still areas of opportunity in Europe, but it's just at the moment very difficult. Even if politics resolves itself, we've still got trade war overhang as well as earnings trajectory.
Is there a limit, though, to how far the US can diverge from the rest of the world in terms of its performance? I appreciate it's sucking in money from everywhere. You can just see it happening in terms of the valuation gaps that are emerging. Is there a limit to how far that can be stretched?
I think at the end of the day, the limit comes back to, in an environment where concentration is high and valuations is already high, it's harder to think of multiple expansion, but then it comes down to earnings, and earnings has been led by US large tech. Which has very elevated expectation. And so we've seen episodes of earnings falling short of that expectation, which pulls money essentially out of and sentiment out of big tech a little bit. And so even with the preference for US, we've preferred areas where we're less concentrated in large tech. For example, mid-caps is one area that we have liked for much of this year, because if you look at earnings trajectory, even though small-cap earnings growth is still negative, but you're already starting to see that earnings convergence between large and mid-cap, or look elsewhere instead of chasing Max 7, play the same theme by, for example, playing grid maintenance and extension, which also benefit from the rollout of AI technology, but just with better valuation.
Yeah, so there are ways to play some of those AI themes sort of more extensively or outside the stocks that have done really well. We saw another record for US stocks just yesterday. I've lost track now of how many records we've seen during 2024. Do you think, though, that take us to the Asian region here, because we've seen quite a lot of volatility, of course, in that story as well around what China can deliver. And now we're waiting to see if we get more stimulus. But why would you stimulate if you don't know what Trump's going to do? You maybe keep your powder dry. I mean, what are we waiting for from China to get more excited about that story?
I suppose the Chinese policy delivery has been relatively gradual versus perhaps investors have been expecting. Part of that, exactly to your point, waiting to see what will happen on the trade front and therefore calibrate accordingly. I think more will come. There's been a show of willingness in terms of putting a floor on the economy. I think the trade negotiation is probably going to be a prolonged process like last time, and so we should continue to see more fiscal stimulus as well as monetary. And to the earlier point that what's the limit, I think the Chinese assets are quite cheap as well, and so we've seen periods of very sharp squeezes. So having a little bit of exposure to that market to make sure that when that squeeze happens, you can benefit to a certain extent is important.
So those squeezes, though, suggest just trading the Chinese market as opposed to sort of long-term investing because of belief in the long-term fundamentals. Is that the way you see China right now?
I think long-term fundamental turnaround is going to be much more prolonged story, and the intention of policymakers will be a slow recovery, stabilization, rather than one that is very sort of boom-bust cycle as we've seen in the past. And so slow bull market is probably the intention in any case. And right now we're relying on domestic investors' sentiments to turn around. So that will probably be the first story to look forward to.
OK, we'll certainly watch for that. Thank you very much for joining us, Becky. Very good to have you with us on the programme. Becky Chin, multi-asset portfolio manager at Fidelity, going from France to the US and on to China with thoughts about global markets. Let me just tell you, we are seeing a little bit of trading coming through on European bond markets. A bit of movement on the spread, at least, it would seem. 86.6 is where we are right now on the French over German spread. We will be back with more details of where bond markets are trading this morning. We'll head to Paris to continue the conversations on the political instability in France and what that means for French assets. We'll be joined by the head of global market strategy at Natixis. That conversation coming up next. This is Bloomberg. Welcome back. This is the opening trade. It is Tuesday morning, and once again, we're focused on French assets this morning as we are at the moment of truth, in the words of the French Prime Minister, when it comes to the French budget and the ability of the French government to survive under this Prime Minister at least. So this is the futures picture that we have right now. In terms of stocks, we are expecting a little bit of a bounce. We're not expecting to go anywhere on the French market, and that yesterday we were certainly witnessing some underperformance on French stocks as a result of the nervousness around the French banking sector and where the political story might come into the market's focus. And we saw that with banks, and actually that just ticking into the red there. But let's move on to the bond markets, because there we do have some trading taking place already. I'm looking at the French 10-year yield. We're at 2.9%. And really interesting, actually, to be reminded by Becky Chin moments ago that we're actually off highs when it comes to the 10-year yield itself. But it's the spread that we've focused on, and spreads are at a 12-year high versus Germany. So that spread has come down a little bit, but it's still at that sort of upper end of the 80s level, which marks a bit of a step change from where we were even in the summer.
But it's not as extreme. So in theory, we've got the most extreme environment, right? We now know that it's likely the French government is going to fall. But I find it interesting that we saw the move yesterday, but people are talking about 100 basis points, 120
and
basis points.
And we're not there.
We're miles away from that at this point in terms of the spread. 86 is clearly very troubling, and clearly the French government is going to have to spend more money on debt servicing. But we are not, the market is not, it seems overreacting. I don't know. I don't want to use that word, overreacting, but it's not. We're not seeing the most extreme scenarios developing at this point. Now, we may do. We get real political chaos on the back of this. You can't form a government. Don't know where we're going. Can't figure out who the next Prime Minister is going to be. Caroline Cohen was mentioning earlier on the possibility of early French presidential elections. Now, that feels highly unlikely at this point, but there are things that could change the narrative. And
I thought she raised a really interesting point earlier about, you know, the political and legal future of Marine Le Pen and whether that's coming into her calculus as to just what kind of risks she is prepared to take with the French political landscape. And in amongst all of that, Chrissy, the euro, I mean, it's pretty stable this morning, but it was down 1% yesterday. 105.10 is where we trade. And I've certainly received more messages over the last couple of days or so asking questions about parity, and parity really not that far away right now.
And the fact that it may be driven by France as opposed to Germany, which has been the narrative, I think, for the last couple of months as well, that the French story really doesn't hold a candle to the German story relative to the euro performance. That being said, this morning you are seeing a tiny tick higher in the euro off of Swiss CPI. It looks like you are seeing those numbers break across the Bloomberg terminal, bang in line with expectations, higher by about 0.7% in November, month over month. The reason this is important is because for about the last couple of months, you have seen downside surprises. This actually marks a slight tick higher from the 0.6% we saw over in October. That, of course, pressuring, well, I shouldn't say pressuring, but I should say weakening, perhaps, the Swiss franc, and certainly giving a teensy boost to the euro.
But it feels like we are where we were yesterday.
Yeah.
The move was yesterday. Today is the market's now done the move.
Catching up.
Well, it's not even catching up. I think everybody saw the news yesterday and is now waiting for the next bid. We're in this kind of hiatus period, it feels, between the news that we are going to get the no confidence vote, and then figuring out who's going to be the next Prime Minister and what ultimately the budget is going to look like.
I wonder if this kicks the can down the road to like December 20th. If this is ultimately becomes kind of a pre-holiday volatility story at the end of the day.
Looking forward to Christmas in Paris?
I am, actually. 2 days after, but yes, I am. It'll be great.
Look beautiful.
I hear the Christmas lights put London to shame, and that's saying something because they're stunning here.
Right, let's stick with France.
Let's turn our attention back to France. We can speak to Mabrouk Chetouin, Head of Global Market Strategy at Natixis, who joins us now from Paris. Mabrouk, we saw a big move yesterday in French assets. It's not continuing today. What should I read into that?
Well, I think I do agree with you when you say maybe the market is not overreacting. The market is, looking at the situation, and clearly the market is telling us that he's worried about the situation, but not overreacting yet. 90 basis points, the difference between the OIT and the Bund is not, something that could trigger, let's say, negative impacts on the equity market, and because we have already seen the situation. However, clearly the situation is deteriorating in France. The situation in terms of when you look at the budget and the fiscal policy is clearly now a concern for 2025 and 2026, because we need, to have a credible pattern for the budget and for the deficit. Clearly, we are not in the right way to lower significantly our deficit to GDP ratio and make sure that these will converge to this 3% until 2029. So the problem is that now the government has to the situation in France has to be resolved in order to make sure that there is no shutdown. And the Constitution makes sure that this situation could be avoided thanks to some, legal text. But definitely, the market will keep an eye on the situation in France, and there is, let's say, 75-80% probability to see the government falling on Wednesday, tomorrow, after seeing these censured vote being voted by the oppositions.
I saw some Natixis research yesterday. Les Echos quoting it this morning, talking about the fact that if we just see a continuation of the French budget, the 2024 budget into 2025, you basically end up with a budget deficit of 5.3%. That doesn't feel a million miles away from what Barnier was ultimately trying to achieve.
Yes, correct. Because initially, if nothing is done, the deficit to GDP ratio was, expecting to reach, 6%. So thanks to, these project that will be, awarded, but clearly there is a good chances to see the deficit to GDP ratio reaching, 5.3, simply because if there is this, censured voted these on Wednesday, some revenues for the government will increase and some of them will decline. So all in all, there is no wipe out in terms of fiscal policy, in terms of decline of revenues. It is quite decent to see these 5.3% deficit to GDP ratio for the next year, in the sense that we are in a complete uncertainty when it comes to what we in terms of government and in terms of also snap election for next year. This is something that we need to bear in mind. If there is if on Wednesday we don't have any government in France, there is a 100% chance to see another snap election in June 2025.
OK, so yes, that's certainly something that could fall into the calendar. Mabrouk, how much of a hold should this French story have over the euro? We saw it fall yesterday on the back of political concerns in France. Clearly, Germany has its own political questions to answer as well. How much should the French story be dictating how weak the euro gets here?
Well, I think what matters, is, of course, what the situation in France, the situation in Germany, and in terms of timing, it is what we can say. This is the worst timing for us, for European countries, and for euro, simply because when you look at the situation in the US, it's completely different. In the US, they have a good idea of where do they stand and where do they go. In Europe, we don't have any idea about, what could be the outcome of the election in Germany in February 2025. We don't know exactly where we are going in France. And of course, this uncertainty is waiting on, the currency is waiting on the equity market and waiting on also the bond market. All the capital markets are affected by this uncertainty. And I will not be surprised, if there is, if there are negative developments in the coming hours and days, to see, the euro continuing to decline against, the USD and against also the CHF, the Swiss franc, because, the investors are looking for, more visibility, and they will play safe asset like, the Swiss franc or the USD. So definitely, the situation is not very good, for the capital markets and for the currency market as well.
And how much should it weigh on banks, Mabrouk? We saw it yesterday weighing on BNP, on SocGen, on a host of French banking names, but other French large caps also coming under pressure. How much should this be sticking to stocks?
Well, it could continue. Again, the situation, this deterioration in the visibility of the French situation could continue to weigh on capital market and on the equity market, and especially on the banking sector, because this is the first victim of this uncertainty. Clearly, this deterioration of the environment is clearly declining. The confidence of everyone. Households, corporates, and so on and so forth. And then their willingness to invest or to develop. Their business could be impacted, and this in turn impact the banking sector. So each time you have, I mean, uncertainty that comes from, I mean, the policy and and politics and the political side. I mean, we have, I mean, these banking sector suffering a lot, and it will probably continue because there is no chance, I mean, to see something good emerging in the coming days. When it comes to the capital market, I mean, to the large cap, same thing. I mean, when you look at the global environment and the factors that are impacting the large cap in France, I mean, China is still, I mean, still a source of concern for the luxury sector, which is a big, I mean, a big weight on the French index. The situation in France, the global, I mean, economic cycle in Europe is not, I mean, well oriented, and the situation in Germany also, we have talked about this, is also a source of concern. So definitely, I mean, the global situation in Europe is not good for, I mean, the capital market and for the equity market per se.
Mabrouk, connect the dots for us here. We started off this conversation by asking whether these budget changes in France actually make a difference. We're seeing that those kind of jitters reflect in the bond market, as Anna and Guy pointed out. But what is the feedback loop when it comes to growth? How do you measure that, and how do you trade on it?
Well, so far it's very complicated. I mean, to say, okay, it will have a significant decline in growth and for the outlook for 2025. The first thing that we can say is that definitely when we have, I mean, such negative environment in terms of outlook, what households are doing in France is that they're increasing their saving rate. I mean, if we have, I mean, uncertainty regarding, I mean, the fiscal policy, and if we don't know exactly what will be, I mean, the taxes that the households will pay, the taxes that the corporates will pay, at the end of the day, the immediate reaction of households is to increase their saving and to lower their consumption. And these, I mean, this effect is well known by the economic theory, could definitely, I mean, lower GDP growth rate expectations, and in turn lower, I mean, the projections for deteriorate the projections for the fiscal deficit. So all in all, I mean, the situation is extremely, I mean, let's say, concerning and worsening in France, because this uncertainty is clearly the worst enemy for everyone.
But Mabrouk, is the volatility that we're seeing in these yields, these widening of the premium to German debt, is that pricing in jitters, or is that pricing in that feedback loop that you just outlined? What is the market actually pricing in right now in that premium?
That's an excellent question. I think the market is trying to stay calm and not, I mean, overreacting. The market is, I mean, now, this situation has started in June. So this is not, I mean, something that we are discovering. And since, I mean, the nomination of Michel Barnier government, we have, I mean, somewhere in mind, the probability to see this government falling at some point. So it has come, I mean, with the budget, which is, I mean, not a surprise. But the market is not pricing a substantial deterioration of the situation. The market is trying to stay, quite calm regarding the situation. And we have also to bear in mind something extremely important, that, I mean, we have the tools at the central bank level and at the treasury level as well to address, I mean, any situation when it comes to the fiscal deficit. So far, the market is not overreacting. The market is not pricing a substantial deterioration of the situation. And this is not, I mean, the moment to panic, in my opinion. So this is exactly what the market is telling us. Let's wait and let's see what will happen in the coming days.
Maybe not the moment to panic. Some would argue the panic is in the rearview mirror and not going away anytime soon. Mabrouk Chatouane will lead the conversation there, head of global market strategy over at Natixis. We thank you so much. Coming up on the program, we're going to shift to the equity story here. ASML does not see an impact from chip export restrictions to China in its 2025 outlook. We're going to bring you that story and your other stocks to watch next. This is Bloomberg.
Welcome back. This is the opening trade. 7:47 here in London. 8:47 if you are in Paris right now. And a lot of our attention goes to Paris at this point of the year because we are covering, of course, extensively the plight of the French budget and the plight of the French government. So in terms of the futures picture, we're pretty flat, really, for most of these markets. We will, though, be paying close attention to whether we get any sustained weakness in France. The bond market story looks a little calmer today than it did at parts of yesterday. So let's bring into the conversation our Markets Live columnist, Ven Ram, who is with us, joining us now from Dubai, can talk about the markets in 3 minutes with us. And Ven, let's start with what's happening in European bond markets, because, yes, we focus a lot on the volatility of French bonds over the last 24 hours or so, but we're also seeing what this is having an impact on other bond markets within Europe, notably German yields. You say that this is keeping the lower for longer narrative on German yields alive and therefore keeps the euro on the back foot. Just how weak does the euro get from here then, Ven?
Well, I think that the euro is going to be on the defensive for a short, over the short term. If you look at the wall structure, the term wall structure of the euro, it is showing an inversion that kind of suggests that investors are thinking there's worse to come for the euro in the short term. So I think that, we could do 103 levels, 102 levels, depending on how far the French political crisis grows. But it's not just about French politics that's uncertain in the Eurozone at the moment. We've got plenty of other factors playing into it. We've got a German election, snap election, coming up in February, and we don't know what actions Donald Trump may unveil once he gets into White House in terms of tariffs. So all that are going to keep the euro on the defensive. What is the incentive to bid up the euro at the moment? That incentive is missing, and therefore the euro is going to be lower for longer.
Ven, can I just come back to the European government bond markets, EGBs? Is it a zero-sum game? If I sell France, do I buy Spain or Germany? Does the money stay within the euro system?
Well, I think that, there is a case to not ignore French bonds altogether. You're not going to make money buying French bonds today and tomorrow, but you need to look beyond the short term. If you're going to buy a 10-year French bond, what do you get? You get about 2.9% in yield, but that's not about it. If you decide to hedge the currency risk by surrendering the forward premium in the markets, you're going to get a pickup of about 170 basis points. So that will take you to about 440 on the 10-year French yield. Now, where do you get that? You won't get that even in US 10-year treasuries. So, and then let's keep in mind that France debt is still rated AA-. So S&P reviewed the rating as recently as Friday and decided to keep that rating intact. So, French bonds are trading more like Spanish and Italian bonds. If you look at the Italian 10-year yield, it's trading at 325. So the gap between France and Italy is very subdued, which means that investors are already trading French as though it had suffered another rating downgrade. And so there's a lot already in that price, and therefore there is some value to be had if you buy French assets at the moment.
All right, Ven Ram, we will leave the conversation there. It's a lot happening, as you point out, in terms of that yield premium, certainly seeing very different directions of travel for the various countries that you mentioned. Ven Ram from the Bloomberg Markets Live team, we thank you so much. You can get more up-to-date analysis from him and the team. Just type in MLIV Go on your terminal. Let's go from the macro to the micro and get our stocks to watch. Joe Easton standing by. Joe.
Morning, Kriti. So ASML has given some reassuring comments on the potential impact of restrictions from the US on chips and chip machinery sold into China, saying they don't expect it to impact their current fiscal year and also into next year. They say this is already factored into what they gave in terms of the guidance in their latest quarterly earnings. Now, we did see a bit of volatility in this stock yesterday. It was weaker at the open, then kind of recovered, but this potentially is going to be another relief for ASML today. Then in terms of luxury, Salvatore Ferragamo reckons it could get an impairment of around 90 million euros in terms of a hit from the slowdown in the luxury sector. Now, this is already one of the worst performing luxury stocks in Europe year to date, with losses even bigger than the other strugglers like Hugo Boss, Kering and Burberry. But there's already actually 8 analysts with sell ratings on this stock. potentially suggesting that the negativity is already priced into this one. Only one buy on Salvatore Ferragamo at the moment. Then in terms of insurance, we've got an investor day today from Swiss Life, and the company is predicting a bit of an increase in one of their key targets. Their return on equity could rise to as much as 19%. They're also announcing a 750 million Swiss franc buyback and pledging to increase their dividend payout ratio as well. Now, this has been one of the outperformers in the sector already year to date. They have recently reported some pretty strong fees, and this potentially is going to increase that trend today. Then, in terms of your rating changes, a couple of interesting ones in autos this morning. Mercedes is an underweight over at Barclays, whereas the rival BMW is upgraded at UBS. We're seeing that one higher on the Tradegate exchange this morning. And then finally, in the UK house builders, Persimmon gets a buy rating over at Citi, one to watch in London this morning.
Thanks, Joe. Joe Eason with an update then on some of those analyst changes and the stocks that could be on the move. Broadly speaking then, the futures picture for Europe, I mean, it looks a little more relaxed perhaps than it did yesterday. The bond market story looks a little bit more relaxed, as you were pointing out to us earlier, Guy.
It does seem as if the market... So we had a bit of a storm yesterday, Barnier storm. Markets reacted to the news that we are going to see potentially this government fall. Today we wait and we watch what happens next. We don't know yet. We're assuming that the government is going to fall, but what comes beyond that? We're going to know that within the next few days, in theory. So maybe today is just a day to kind of figure some of that out. The market doesn't seem to want to jump to the next step yet.
Maybe these CAC futures just worsening a little bit in the last half hour, though, Kriti.
Yeah, I was going to say the overhang here, even though we are kind of the calm before the second storm, the second wave, I guess if that's what we're going to call it. The overhang is interesting, and I'm curious at what point you start to see a little bit of bottom feeding there, which I think we've seen in other European regional stock stories, but we haven't seen in France just yet.
And it's not a European story, which is also interesting.
Yeah.
You're not getting this European effect. You're getting...
Or at least it's not European negative. Like Ven's point, it's affecting German bonds, but it's not for reasons of nervousness and panic.
Yeah, exactly.
Because it can be a bit of a haven in that storm. Coming up, we will bring you the opening trade then. We are just 5 minutes away from the start of Tuesday's trading session. This is Bloomberg.
Tuesday morning, good morning. Feels a bit leisurely out there this morning. We saw a lot of action yesterday. We were pricing in the French trade, figuring out what may happen next with the French government. Today, we're not seeing that much action, either in the bond market or, to be honest, in the equity market. There's no clear steer out of the United States yesterday. Equity pushed a little higher, but not by much. We wait and see what politics in Europe is going to do to French equities, to European equities. There's no clear sense of direction at the moment coming off this French story at the moment that hasn't already been priced. So there you go. That's the story. That's where Europe finished. That's where the US finished. Tiny little margin. That's what's being priced into futures this morning, Kriti.
Yeah, it feels like a little bit of a snooze fest. And I say that hoping we get some action at this open, specifically because, as you mentioned, we keep talking about the French story, and that is an overhang. You can see it, even on kind of a little bit of a sleepy day like today. There was still a very notable underperformance from the CAC 40, a margin of about 0.4% between that and what you're seeing in the FTSE 100. Even worse when you go to the rest of Europe. But that 0.2% of underperformance, Anna, I think is where the story is.
Right, yes. So we'll watch for some weakness, perhaps in the French banking sector again. But yesterday it was a little broader than that as well. So we'll look for some of that at the start of trade then, Kriti. In terms of individual stock movers, a reminder of some of the stories that Joe was running us through just before the break. ASML certainly in focus, reaffirming, despite we've seen these extra curbs on the ability of Chinese chip buyers to get their hands on some of the technology from the States, ASML sticking to their targets for 2024 and 25. We've seen an update from Ferragamo as well. So they've confirmed their outlook, but they do see the potential for an impairment next year. And so that's something that could hit the stock. And Swiss Life in focus, they've increased some of their key targets and announced a buyback then, Guy.
Let's talk about this market open. It is time for the opening trade. We'll get the UK market first of all. Not really going to be where the focus is. We'll watch to see what happens with France today. Yesterday, some fairly big moves, as we've mentioned. There were other factors. We obviously saw the auto sector and the luxury sector in focus. So the FTSE 100 go nowhere. We're watching that one peripherally. France a little bit more interesting. So the IBEX is open, it's up a little bit as well. We're going to see the Stock 600 opening up a little bit. There you go, 0.1%. We wait for the French market to fully price and therefore give us a better steer on what exactly is going to happen in Paris today. The DAX, there's a little bit of news around the DAX this morning, but not a great deal. Swiss inflation data out this morning, unlikely to affect the market. But there you go, the CAC 40 pretty much in line with everything else in terms of the opening trades that we're seeing. It's up by 0.1%. Doesn't look out of kilter with the rest of Europe this morning. Maybe a little soft, but only a little soft. And that seems to be the story. The DAX and the SMI, well, they'll bring up the rear. We'll see what happens with those in just a moment. But the story at the moment is a little bit of underperformance from France, but nothing significant this Tuesday morning, Chrissy.
You know, we say that on an index level, and then when you look at kind of the individual movers, when you look at the underperformers, they are largely concentrated in France. Your outperformers are ASML, Novo Nordisk, your heavyweights, the sensational/core 6, if you will. But the underweights do seem to be, or the underperformers do seem to be a lot of the French names. But Anna, when it comes to kind of index performance, I am seeing, I'm going to try to say this right, Orange. Right?
Mm-hmm.
That's how you pronounce it.
Yeah.
I'm so tempted to say orange. The Orange story. We know that is going ex-dividend as well, but that's already accounting for a decent chunk of the move downward.
Right, yeah, we've got a couple of ex-divs over in France once again. Thales as well as the other one. In terms of where we're seeing the gains coming through, Basic Resources not doing too badly this morning. We're up on Glencore by 1.7%. We're up on some of the other Anglo-American, Antofagasta, Rio Tinto, making some modest gains. Iron ore prices were a little stronger through the Asia session. That does sit counter to the China narrative, though, which was one of underperformance, given disappointment around some of the meetings that have taken place and stimulus levels coming through. That seems to be the narrative coming through from the Asia session overnight. Consumer products and services, though, the best performing sector today, which does make me think of Paris, but there aren't a huge number of French names in the mix there. It's more kind of home builders in the UK doing well in that sector.
OK, there we go. France is up by 0.3%. Can I just say that?
Yes, say it again.
I'm looking at the DAX that's up quite a lot, though. So I just want to double check in and see.
DAX not doing anything on my screen.
Yeah, I think I may have a dodgy number on my screen. But France doesn't look different today in the way that it has done over the last few days.
Is this the bottom feeding that we were waiting for? Is this the buy a little bit because this is a part of the stock market that maybe has been underplayed, underloved, if we will? Let's ask a true expert. We're joined around the desk by Luke Barrs, head of fundamental equity client portfolio management over at Goldman Sachs Asset Management. I'm going to put that question straight to you. France has underperformed. At what point is France attractive again?
So I think, Kriti, the key here is just to understand what you're buying. And I think just generically saying we want to buy French equities or European equities is still difficult because we don't have that underlying growth dynamic that we see in other parts of the world. But selectively, and I think this is kind of what you're alluding to, there's some fantastic businesses in France and in Europe that actually cyclically we think have positive momentum and are still valued and priced as if there's significant challenge in the horizon.
Does that actively change the story, though, around how you allocate to France? I mean, one of the big narratives we've had this morning has been, well, does anything actually change by the end of the week? Does anything actually fundamentally change in terms of the economics and the growth picture by, say, the end of the year? S&P doesn't seem to think so, but the markets do. How do you square the two?
Well, so I think what we have seen is a growing amount of uncertainty around the dynamics going into next year. But actually underlying that is still a very favourable global economic backdrop, especially in the US. Yes, we have change in political leadership, but actually you think about the underlying fundamentals in US economy, it's very strong. I would say one of the key trends we are observing in the US from an equity perspective is this broadening out of growth. So we've been very centred on a handful of very large cap, technology-orientated names. We still think there's resilience in fundamentals there, but actually the smaller cap part of the ecosystem where if we do get the domestic growth story coupled with continuation of Fed normalization of rates, that's a very favourable cycle in the small cap space. So I think it's about selectivity. It's about finding, OK, where are the areas we can see that growth opportunity coming through, and where do you still feel comfortable with the valuation that you're being asked to pay?
Do I need to hedge the downside in the States and the upside in Europe?
I think there's a degree to which we need to look at our overall portfolio allocations and think about the relative spread in valuation. And so what we are seeing, both in terms of our portfolios, but also in terms of asset allocator decisions, is some degree of diversification to hedge potentially a higher multiple that we're seeing in the US against what is clearly a cyclically low point in many other parts of the world. And so I don't think it's as simple as just saying, sell down US large cap, buy non-US equities, but selectively we are seeing.
So how do I hedge that risk? How do I hedge the downside risk in the States, super high multiples, et cetera, and super depressed valuations as well? How do I actually in reality do that?
So I think in simple terms, one, do take a little bit of profit as we've seen in some of those mega cap names. We think, yes, there's still strong fundamentals.
At the moment.
It has been. and what we're seeing is that trend of down cap in the US. So whether that's a hedge or whether that's just trying to reallocate towards areas where growth and fundamentals and that progression of earnings is going to be more favorable, that still seems positive. And then in the non-US space, I think it is rebuilding those allocations in core Europe, specifically in Japan, where we're seeing a very strong macroeconomic backdrop, and then selectively across emerging markets where actually as much as there is this very heterogeneous dynamic and underlying fundamentals are very diverse, the actual earnings progression is still very favourable.
And I know that, on emerging markets, I know you've been talking about India quite a lot recently and been to India, and we'll talk about that maybe in a moment. I just want to ask you about the US story, though, picking up on what Guy was saying about the risks there. Is there a risk going into 2025? I mean, this feels like the same risk going into 24, that we don't get the number of rate cuts that the market has priced in. Now, back at the start of this year, it was something like 7.
Yep.
We didn't get all of those, but we got a couple. Yep. Going into next year, we're at a point of inflection where the market is not really sure how many Fed rate cuts we're going to get. Is there a risk for stocks still that we really don't get that many cuts, and that isn't what the market is priced for right now?
I think there's a little bit of a risk there, Anna. So let's just, again, rewind to the beginning of this year. The market was saying 6 or 7 cuts. We were actually fairly sceptical that we would see that many, but we did think we'd see the normalization of that rate cycle start. And again, whilst we've seen far fewer rate cuts, we've still seen a very positive dynamic for equities. And so as we go into next year, again, even with the dynamic of the Fed likely cutting another 3 times into 2025, we don't think that's a challenge for equity markets to absorb, as long as the underlying growth fundamentals come through and continue to be resilient.
And thinking about your outlook for 2025, I was looking through the document there, and it sort of looks like an extension of this year, and yet we know there are big political risks potentially on the horizon. I mean, you're talking about lower interest rates globally, even, to some degree, more in some geographies than in others. You're talking about favouring fixed income. You're talking about US stock diversification and an increased role for private markets. Those sound like themes we've been already dealing with in 2024. I suppose there are always political risks, though.
There are, and I think it's understanding what is the true impact of those political risks. And so, again, let's look at it in the simple context of what we're seeing in US in terms of transition of leadership, what we're seeing potentially in Europe in some of the challenges that have come up more recently. Yes, that has a bearing on risk premium. Yes, it has a bearing on sentiment. But actually, if underlying earnings growth is still in the high single, low double-digit range, and selectively, if you can be active within that space and find the right businesses that are seeing that progression of fundamentals, that to us doesn't seem like it's particularly challenged.
But does that, by that argument, do valuations even matter then? And kind of bringing it back to Guy's question here is that if you're looking to hedge or even hedge the downside in Europe, does it matter how expensive things are in the States when all you really need is exposure at the end of the day?
So I think, Kriti, there's 2 parts to this. One is the long-term statement, which US preeminence and that US long-term growth story, we think is still very much intact. And if you think about some of the major dynamics, that intersection of geopolitics, of supply chain restructuring, of AI, the US is a very strong beneficiary of all of those trends. And that re-onshoring of manufacturing into the US, what that creates in terms of domestic growth, should be very favorable for US equities. However, we are very cautious on larger cap US equity multiples, especially where we've seen very strong cyclical strength in fundamentals. And so whilst we would still say from an absolute perspective we see progression of the US large cap equity space, we do think it's prudent to take a little bit of profit and at least normalize that exposure, because the outperformance has grown that allocation for many of our portfolio investors.
Do you see any catalyst, though, for something more substantial, a more significant downdraft in US assets? The American story has been one that's been driven by valuations and earnings, but it's also just been driven by flows, which have been a huge kind of part of the narrative. Is there anything that could upset those flows? Does America still look like the safe haven play around the world, and therefore it continues to attract those flows?
Look, so I think to a degree, Guy, the underlying economic dynamics in the US are very favourable. And if you look at the US economy versus other parts of the world, that still gives you some protection. But I do think their valuations are relevant, and we are being asked to pay a high multiple for US large cap equity, so you have to be a little bit cautious. Politically, I think there are things we're going to have to digest as investors, and there are the unknowns that we'll see going into next year around trade policy, whether you see some increase in inflation as a function of tariffs being imposed on other trade partners. But that to us doesn't necessarily derail this soft landing idea and the fact that for underlying earnings still remain fairly resilient.
And then going back to what you mentioned earlier about emerging market opportunities, you have been in India, you've been talking, this is the 5th largest economy in the world now, and you remind us, according to your analysis, or that you cite at least, it's going to be the 3rd largest by 2027. opportunities in infrastructure, digital, startups? Where are you most excited when it comes to the India investment story?
Well, so I think first and foremost what you have is an economy that is at the tipping point in terms of structural growth acceleration. And so I think in terms of finding visibility, and to Guy's question earlier, where do we think about the opportunities longer term and how do we absorb some of those overarching risks? An economy that can grow at 6 or 7% real, 10 to 12% nominal, that's something that's very compelling, especially because it translates those into corporate earnings pretty significantly over time. Now, I think in terms of where the opportunity lives today, it is very diverse across the Indian landscape, but I do think the infrastructure side of things and the uplift you're seeing in infrastructure is very compelling. What I was most surprised about when I was in India 2 weeks ago was how significantly the manufacturing base has accelerated. Not just in terms of the scope of manufacturing, what you're seeing in terms of the production-linked incentives, the investment that you're seeing from international manufacturers into India as a China plus one diversification story, but just the quality of the manufacturing infrastructure. This is first world automated manufacturing industry that you would find in many other parts of the world and think, OK, that's very market leading. And so for India to build that and to start that growth dynamic underpinned by high-end, high productivity manufacturing, I think is very critical.
It feels like the common theme here and everything you've laid out is this kind of almost government-driven incentive and infrastructure boom. You mentioned it in the United States. You mentioned it in India. All of those are largely fiscally driven. Is that the handicap of Europe? Is that what we need to see to have maybe more excitement and more fund flow into Europe, the likes of Emmanuel Macron, the likes of Olaf Scholz or whoever comes next, basically incentivizing some of these bids? We saw this in the Biden unwind. We're seeing this in the Trump trade. Is that what Europe needs?
I think there's a very critical part of what Europe wants to do in the next 10 years that is underpinned by that. And you look at some of the comments Mario Draghi made around competitiveness in Europe, and it's very much underpinned by we have to find a collaborative way of finding growth within Europe through that fiscal investment cycle. I'll give you one simple example. If you think about semiconductor manufacture, and we know that the world is very dependent on manufacture in Taiwan via TSMC, and we know that there's this dynamic of trying to re-onshore manufacturing into key developed markets. Both Europe and US have established fiscal agendas to subsidize that program.
Yeah.
The US is now effectively giving money to corporate entities to put facilities on the ground in the US. The European side of things is still debating it.
Yeah.
And so that pace at which you can execute, I think, is crucial. And so to your question, I think absolutely as Europe thinks about competitiveness in critical areas like technology, like in healthcare, to a degree, the continuation of the Repower EU trend as we see this bigger draw on the grid for power, all of that needs collaboration, and that can help facilitate a better growth dynamic across the continent.
So all the things you just laid out that maybe Europe as a whole is not doing, Italy seems to be. Giorgia Meloni seems to be on it. Is that the right playbook? Are we seeing that yield and bear the same fruit that maybe we're seeing in other parts of the world?
Also, I think what has been very interesting as an investor into Europe in the last couple of years is to see how stark the contrast is today versus maybe 10 years ago in the height of that European sovereign bond crisis. And what I mean by that is you think about peripheral Europe and how well those economies are doing and what that means in terms of corporate earnings progression. And actually, there's some very attractive, bright spots within those areas. And so I think Italy, Spain, even Greece now, you're seeing a lot of opportunity from a fundamental bottom-up perspective that maybe wasn't there previously and people have sometimes forgotten because of the historic issues you have around the sovereign side of things.
Nice to see you, Luke. Thanks for stopping by to see us.
Thank you so
Really
much.
appreciate it. Luke Bartz, Head of Fundamental Equity Client Portfolio Management at Goldman Sachs Asset Management. Thank you. OK, let's take a look at the Core 6. This is what we're seeing in terms of the story across Europe, largely in positive territory, as you can see. LVMH, which I'm reliably informed went ex-dividend yesterday, is today up by 1%. Ferrari's up. ASML, as you can see, up by nearly 2%. Let's get some of the other stock stories that we're watching so carefully this morning. Joe Easton, over to you.
So we are actually seeing a decent gain in Salvatore Ferragamo today over in Milan, rising almost 6% at the open of trading. Now, remember, they have announced that they could potentially see an impairment of around 90 million euros in the next financial year. But as Anna mentioned earlier, they've also reiterated their broader outlook for the year ahead in terms of the luxury company, already down around 50% heading into today for the year to date as well. So coming back up a bit. Swiss Life, meanwhile, now that looked pretty bullish in terms of the buyback, dividend and also the return on equity targets, but potentially people were looking for more ahead of the investor day for the insurance firm. So actually a significant move lower in Swiss Life today. Their investor day clearly disappointing some in the market, falling around 4% for that one at the moment. Then we've got our eye on Worldline over in France. The stock jumped almost 20% in late trading yesterday after Reuters reported that the company, the payments company, has faced some private equity interest, including from Bain Capital. Now, we have reached out to Worldline, who declined to comment on that, but we're seeing another gain for that stock today. As I say, it was up close to 20% yesterday, another almost 3% move for that one. In terms of your ratings, it's all about autos today. Now, Mercedes getting hit. They've got a couple of downgrades, but one of the big ones is over at Barclays. They go underweight, slashing their earnings estimates for Mercedes in a note to clients today. So that one getting hit. But going the other way is BMW. Now, analysts over at UBS say that this is their favourite equipment maker in the entire auto space, according to their note today. That's their top pick in Europe, and as such, we're gaining 1.7% for BMW this morning. Then Persimmon, this one caught my eye because yesterday we had a downgrade at RBC saying that the returns, the outperforming returns, are not likely to continue. But today we've got Citi giving the opposite view, saying that this is the best way to play a recovery in the UK housing market. So they upgrade Persimmon today, and Persimmon shares rising 1.4% in London this morning.
Joe, thank you. Joe Easton from our equities team. With some of those stocks on the move, we've got another few stock stories to bring you. We'll continue to follow those as we come back from the next break. And coming up on the programme, ASML maintains its sales forecast for next year, despite new curbs on chip exports to China unveiled by the United States. We'll have details next. This is Bloomberg.
Bit of news coming out of China relating to rare earths. China banning germanium and gallium exports. Germanium apparently sits between silicon and tin on the periodic table. Probably quite useful in terms of manufacturing a silver grey metalloid. Anyway, that's about as far as my knowledge goes in terms of the chemistry around all of this. But I'm sure it's pretty critical. This is in principle. Feels like we're going to see some tit for tat. Feels like this is maybe a response to what we're seeing in terms of some of the restrictions that are being put on high bandwidth chips, which have just come out of the United States in terms of the restrictions that are being applied there. Anything you can do, I can do better in terms of the response that we're maybe seeing with this. So maybe it is related to what we're seeing here. Anyway, China's saying it's going to impose stricter review of graphite exports to the US as well. This is clearly going to affect the tech sector. How it affects the supply chain remains to be seen. But let's carry on with this chip story and try and understand maybe one side of it. ASML maintaining its 2025 net sales forecast. The US, I was just mentioning, unveiling additional restrictions on chip exports to China. We're seeing this coming out of the Biden administration. Remember, we're not even in to what we're seeing potentially with the Trump administration. Let's get more on this with Sarah Jacob, who joins us out of Amsterdam. Talk us through the carve-outs that ASML is seeing here and the implications for ASML as to these new restrictions.
As we know, the Biden administration has been advocating to curtail China's technological ambitions for some time now. As part of its latest move, the U.S. unveiled new restrictions on Beijing's access to vital components for semiconductors and AI. So the U.S. essentially introduced fresh curbs on sale of high bandwidth memory chips made by U.S. and foreign companies, and this would affect everything from SK Hynix to Samsung Electronics and Micron. But it also expanded its curbs on chip-making equipment, and this is where ASML fits in. So in a late evening statement yesterday, it said it doesn't expect any direct material impact on its business for this year. But for next year, it said the impact will fall within what it's already guided in its third quarter earnings. So it essentially reaffirmed its forecast for next year and said that China will account for around 20% of its total net sales next year. It also confirmed its 2030 targets, for net sales to be between 44 billion and 60 billion. The company did say that if a similar security assessment is also made by Dutch authorities, exports of its DUV immersion lithography machines to these locations, essentially China, could also be affected.
So ASML saying they're not seeing an impact, but flagging some risks around the Dutch response. Sarah, remind us how much the Dutch have followed the US lead here, because in some cases I think they have, and in others been less keen to follow what the Biden administration has been doing.
Yeah, it's important to see. We had sort of a wait and watch approach for a lot of this year. We've had a new government come in, the Netherlands, in July, and we're going to see what approach they take. It's also in the context of the Trump administration coming in. So there are a lot of moving parts here. So it waits to be seen what the Dutch government does.
So, Sarah, walk us through the story, though, and you mentioned the Dutch government. There's a labor piece to this as well. As Guy mentioned at the top of the program, we're already seeing these kind of export restrictions in terms of things like chemicals, for example, or these materials, the germanium and the, did I say that right? Germanium and gallium as well. But the labor piece, I think, is extremely important as well, because that seems to be where the Dutch government is having more of an effect on ASML than this tit for tat trade war. Is that a fair assessment?
This was something that came out a little bit earlier when ASML, talked about the business climate in the Netherlands and, having the ability to hire foreign talent easily, and they had something called Project Beethoven, which sort of also met these demands and also looked into for infrastructure building around Veldhoven in where ASML is based. But so far, that's what's already been announced, and the government has sort of met a lot of ASML's concerns there.
All right, Bloomberg's Sarah Jacob walking us through that chip story out of Amsterdam. We thank you so much for walking us through it. At the same time, we're keeping one eye on ASML stock. That, of course, higher in the session, paired some of those early gains, but still in the green. Staying the exact opposite move is Atos, of course, the French software company as well, seeing a drop of, last time I checked, something like 14%. This is a penny stock, though, so we know this is a pretty drastic move, but we're still unclear of what's driving this drop.
I've been canvassing opinion. Nobody seems to have a particularly clear view on what it is. Maybe it's a retail action, but it is a penny stock. That's why you get the big moves that you get. If you look at actually the underlying, i.e. the actual price, you can see a tiny move and a big percentage move, and I think that maybe is...
Yeah, maybe the two are related. I mean, it was interesting that just in the last 24 hours, I think, we heard that this Atos consortium, we got further negative news flow, at least, surrounding the rollout of the biometric border system for Europe. And given the amount of time that politicians spend talking about migration, this clearly is a story that's going to get a lot of political attention, and that's not going to perhaps play well for a business such as Atos. There had been a lot of expectation about these smart border systems tracking the movement of hundreds of millions of travellers in and out of the block using fingerprints, facial recognition. Maybe that has something to do with it. But yeah, as you say, penny stocks.
What are we going to be doing next? We've got some great guests coming up.
We
should probably figure out what changes as a result of the political instability that we're seeing in Europe from a business climate point of view, I think, is one of the key questions that we need to figure out.
Yeah, absolutely. And so we're going to put that in the context of M&A. I was reading, actually, just overnight, some of our colleagues' capital markets watch piece out around Europe and around the lack of IPOs in France right now.
Yep.
And this is linked to our next conversation because, we've got a lack of IPOs because the business community may be not feeling confident to come to market, given what we see in the politics, and maybe that plays out for M&A as well.
Does it start to show up in PMIs? We're already seeing some evidence of that already. Clearly, the PMIs are weak. Does that continue? How does the latest bout of political instability actually affect those numbers? Because you compare and contrast France and Germany. In some ways, Germany is got a kind of route out of this. It can figure out what the politics is going to look like. We do have an election coming up. France feels like it could be mired in this political instability for quite some time.
Yeah, I think the capital markets piece is a crucial one, though, because you need that stability to get things going. We've had that conversation here in the UK as well. And just on that quick note of the M&A space, you had even this morning CVC Capital Partners out of Amsterdam trading down 5% because they've struggled with some of the major IPOs in Tokyo, pulling that listing on those valuation
We will put capital markets and the link between politics and capital market activity in focus then next. We'll be joined by Richard Madden, Executive Chairman for Europe at DC Advisory, to talk about deal-making and the M&A outlook. This is Bloomberg.
This is the opening trade. We're 30 minutes into today's session, seeing some pretty broad gains across of Europe. You see Eurostoxx 50 higher by about 0.9%. And France is the outperformer, higher by about the same margin, also higher by about 0.9%. This is enormous because, of course, we do know there is a political overhang. We thought there would be one in the futures picture. That has completely turned around 30 minutes into the trade. Let's continue with that story, though, because perhaps you're seeing it reflected in other parts of the market. The spread between French and German debt has narrowed slightly after widening the most in 6 months. Yesterday, traders waiting for the latest developments out of Paris as the government is on the brink of collapse. We're joined now by Bloomberg's Caroline Conan, of course, covering the story bit by bit. Caroline, walk us through just how close we are to that government dissolving.
You know, what you're seeing in the markets today, Kriti, may be the reflection of the fact that the collapse of this Barnier government is already priced in, because the chances of this actually happening are pretty high. The National Rally has already said that they will back the motion of no confidence that was proposed by France Unbowed, the far left. This vote of no confidence could take place as soon as Wednesday night or Thursday morning. So clearly this easing you're seeing on the bond market might actually be the reflection of that we're probably going to have a new prime minister, or at least a caretaker government, for a few weeks until President Macron decides to name a new prime minister. The only ray of hope that Michel Barnier may still have, and he's going to obviously call for some responsibility tonight when he speaks to the 8 o'clock news in France, is perhaps reaching out to the Socialist Party. You know, the Socialists, they have 66 MPs in the National Assembly, and Barnier only needs 44 of them to abstain from this vote of no confidence. But that's assuming that the Socialist Party would break up their alliance with the far left. So who knows? Perhaps that's what they want to do. Perhaps that's the way forward. Are we going to see a center-left prime minister next? That's a massive question, of course. But, you know, National Rally of Marine Le Pen has been calling the cards, and it's pretty clear what Marine Le Pen is going to do.
We know what she's going to do. We keep describing Marine Le Pen as the kingmaker. But what does Marine Le Pen want to happen next? When the government is toppled, what comes next? What would she like to see happen? Does she want a continuation of the chaos? Does she want an unstable government to be put back in place? What is the best outcome from her point of view?
So, you know, it's actually very interesting. I was just listening to the Interior Minister, Macron's coalition in Barnier government, saying, Bernard Taillot, she has no rationale anymore since the trial. Since the trial on these EU public funds alleged embezzlement, she's facing potentially a ban from running for office for the next 5 years. We're going to have the verdict on this at the end of March. But technically, in the short term, according at least to Bloomberg economics analysts, she might have more interest in the chaos than stability, because she's looking long term. She's looking presidential elections. She's looking 2027. So obviously this possible ban is kind of hanging over her head as well. And that may play in the balance, even if the National Rally MPs are saying it's not and it's totally unrelated. It might definitely play in the balance for this rationale of this National Rally vote, given Michel Barnier has made some concessions until the very last minute on Monday, including on drug reimbursement, which was one of the key demands by Marine Le Pen.
Caroline, thank you very much. Bloomberg's Caroline Conan with useful insights from Paris around what's going on in France. Let's think about where the uncertainty in France, where it goes, and which parts of the wider economy it starts to infect. We're thinking here about capital markets activity and, in particular, deal-making. We're joined by Richard Madden, Executive Chairman for Europe at DC Advisory. Very nice to have you with us, Richard. Thank you for coming to speak to us. So it seems logical to assume that in the midst of a lot of political uncertainty, and certainly, you know, we've been there in the UK over what, the last 8 years or so, we see signs that capital market activity becomes stalled to some degree. Is that what you would expect to see in France?
Yes, it is. I mean, if you look at the last couple of years in M&A, we were down 24% last year, we're down 5% again this year, reflecting that uncertainty. And M&A is all about confidence, because you're trying to predict the future. If I buy this business today, will it be good for me in the future? And at the moment, the future is very hard to predict. And the more political turmoil there is, the harder it is to predict.
So political turmoil certainly doesn't help with those animal spirits, but is it the whole story? It seems as if there's something else. You're suggesting there's something else that's holding back businesses from doing deals, from going out and buying, from PEs, holding back PEs from buying and selling. What is it that's sort of hanging in the atmosphere that's stopping businesses from doing these transactions?
So interestingly, businesses are less held back than private equity. So businesses continue to see value in getting into new markets, getting into new products and driving their strategy. So they're relatively constant. The real downturn has come from private equity, where they've had a period, frankly, of over 10 years of glorious success where everything just gets better, and suddenly they're in a market where it doesn't just get better and they don't know what to do. They need pressure on them before they do anything.
Could the argument perhaps around the private capital market or the private markets not deploying in the public market simply be that there's too much sloshing around in the private markets, that this kind of massive fund flow that you saw when things were too volatile in the public markets is now creating a supply glut, and therefore the buyers are just able to be a little bit more picky than they would usually be?
I don't think that's it, genuinely, because there is all this money, but what's really happening is you're on a fixed-term cycle, so you've got 10 years, 5 to invest and 5 to divest. But the money is fixed. Unlike the public markets where you can just withdraw it at any moment, it's stuck in private equity. So they will need to do something. So it's not really a question of if they deploy capital, it's more a question of when.
Well, fair, and they certainly have to. They're getting a lot of hedge funds and endowments certainly aren't happy around it. How much of that is at the whim, though, of some of the kind of fiscal governments? I'm going to bring it back to France or even in the UK, where we talk about carried interest or we talk about these taxation schemes. Even in the United States and out of the IMF and the EU, taxing private equity deals is far, far more in vogue. Is that maybe the hesitation, and how realistic even is that?
No, genuinely, because they're still going to make an enormous amount of money if they succeed. It's just
even after
less
paying
enormous.
taxes?
Yeah, it's a bit less enormous. So I don't think that's the driver. I think it's fear. But the real pressure at the moment is not the deploy capital, it's actually to realise capital. Because those investors are sitting there saying, I gave you my money, I expect it back at some point. You have to start selling your portfolio companies. And that pressure is probably greater than the pressure to invest.
Headline in the Financial Times, UK M&A activity sweeps the market with £5.3 billion worth of deals. Is the UK different?
No, unfortunately, the reporting is different. So the press tend to report value. But only 17% of all deals have a value disclosed. So it's just a tiny segment and it's disproportionate.
So that £5.3 billion number is...
It's true, but it's a tiny part of the market. What you really need to look at is volumes, and it's volumes that are significantly down.
Has the UK government undermined what could have been a nascent recovery in M&A activity in the UK as a result of the budget? You're pulling a face. Did things change or not change as a result of it?
Changed somewhat. So if you're in a people-heavy industry like hospitality, then surely it changed because suddenly your earnings profile changed.
Right.
But in most businesses and in most M&A, the macro is not as important as how well that particular business is responding to its particular market on its particular day. And so I think most sophisticated deal makers are looking at the businesses themselves, what they can do.
Bottom up, not top down.
Absolutely right.
So how does this fit? How does this sort of lack of animal spirits then, and you've talked about how that plays out for the PE industry, how does that sit with stocks at yet another record yesterday in the United States?
I'm totally confused by it. I find it absolutely extraordinary because part of it is people are saying, I don't know what a business is worth. And yet you look at the public markets and it's worth a lot. The challenge with M&A is it takes a long time. So if I decide today I want to sell my business, it's a minimum of 6 months, but probably 9 to 12 months before I actually do it.
So is this private equity making an argument for public markets then? We don't know what they're worth, but hey, there's a venue that might find a value.
I mean, you would think there would be more IPO activity, as you were saying earlier. And again, I think that will happen. But again, that's a long process. So you're predicting not what the markets are today, but what they will be.
Isn't Europe cheap? This is the value. This is the story I keep hearing. Massive...
In the public markets? Yeah. I mean, comparatively, but isn't Europe in the doldrums? I mean, look at Europe. When do you think Europe will get better?
Well, some would argue that Europe gets better when European governments invest in infrastructure. If you look at the biggest players in the PE, that's where the juiciest deals are. How long does it stay juicy?
I completely agree. I think infrastructure is a huge driver, but the problem is that people are trying to keep a health service going, and then suddenly they've got to find some more money to invest in the real fabric of their country.
And defence on top of that.
And defence on top of that.
Is that why the premium around these infrastructure deals are so high? Is it a volatility premium, or is it because the investment is actually coming from these fiscal players?
No, it goes actually back to that lack of confidence, because the great thing about infrastructure is you've got long-term predictability of cash flows, and therefore it's a safe place to park money.
Is it ironic that the US is seen as the more stable environment right now?
It's extraordinarily ironic, yes, when you think about the uncertainty that has just been elected. It's extraordinary. But it's a huge economy. There's incredible growth. The animal spirits are always more positive. And people cope with disappointment better. So in Europe, we get disappointed, then we mull it over for years and years in a bunker. In the US, they get disappointed, they learn from it, and then drive on.
So we shouldn't be disappointed by disappointment. We should just get over it, Richard, maybe. So I'm wondering, I'm struggling with the thing that you were saying you were struggling with, which was, strong stocks and yet lack of confidence in private equity markets, for example. I wonder if it's just a different reaction function to interest rates. We didn't get the interest rate cuts we thought we might this year, and maybe PE was waiting for that, whereas stocks worked out a way to go higher despite it. Even tech stocks, which lots of people thought would have been held back by the fact we didn't get lower interest rates.
So I think for PE, interest rates are a lot about how they finance their businesses, because they put debt into it. So now that we know what the cost of debt is and it's on a declining curve, there is reason to feel more positive about it. And as you know, the changes in interest rates flow through relatively slowly into the actual cost for the companies. But at the moment, not only is there a massive supply of equity in private equity, but there's an enormous amount of debt capital in debt funds available to invest. So it should be more positive than it is.
Let me talk about a very specific case study that seems to be spooking everybody, and that's the story of Northvolt. You have a lot of major PE players with a lot of exposure there, betting in a really big way on future of technology and lithium batteries and climate change and all the buzzwords we hear in Europe and certainly in the United States. And then it goes and files for bankruptcy in the United States. How much of that is a tale of caution for private equity players that are trying to invest in the next big thing?
But I've thought it was a great story. And why would you not want to be behind that great story? Because you know that the long-term trend is in that direction.
Yeah.
But at some point, you have to decide that you're going to keep going, keep investing, or stop. And unfortunately, the decision was to stop.
But wasn't that a function, though, of initially a function of pullbacks, again, from that stamp of approval from the German government, the UK government to some extent? So it really kind of comes back to these government calls and decision-making that's affecting private equity. That's usually not a kind of through line that we make.
No, and again, it's brutal for confidence. Those sorts of things are brutal. So the next time there is a project like that, where does the money come from?
Richard, nice to see you. Thanks for stopping by this morning.
It was a pleasure.
Appreciate it.
Thank you.
Richard Madden, Executive Chair for Europe at DC Advisory. Talking of confidence, we're going to talk about the British Prime Minister next. He says that he won't be forced to choose between the United States and Europe. Donald Trump making news over the last 24 hours. He's named his Paris and his London ambassadors. We'll discuss the future of the so-called special relationship next and how Keir Starmer restores a little bit of confidence in his government. That's next. This is Bloomberg.
The idea that we must choose between our allies, that somehow we're with either America or Europe, is plain wrong.
The UK Prime Minister Keir Starmer there speaking in London just last night, a foreign policy speech. Well, that speech came as the US President-elect Donald Trump nominated investment banker Warren Stevens as his ambassador to the UK. Let's get more on some of these UK themes. Our correspondent Lizzie Burden on set with us here in London. And thinking of the special relationship, I enjoyed that President-elect Trump referred to the British as cherished and beloved allies, which was Very glowing praise. So with the focus on that relationship, do we have a sense of what that's going to look like when Trump returns to the White House? Does that give us any sense of what it might look like?
Well, Donald Trump hasn't been so friendly with Keir Starmer, shall we say, before the election. Starmer there saying it's not about being sentimental, it's about being realistic, and he doesn't have this binary choice between the US and Europe. Interesting reading into Trump's pick for ambassador to London. This is a prominent Republican donor. It's an investment banker who was on the Walmart IPO. The job of UK ambassador in the UK is kind of a plum job. You know, you get the pomp and ceremony.
Yeah, fancy house.
Exactly.
Yeah.
And so he
We've all
kind of
seen it.
fits the bill, doesn't he? That's the personnel. Policy-wise, a key plank is going to be what happens on Ukraine. And yesterday I was speaking to the UK Defence Secretary, John Healey. I asked him, are you going to put the special relationship over back in Ukraine if Trump pulls support for the war? And he said it's Ukraine that's fighting. It's up to Zelensky how and when he comes to the talks. And until then, Britain's going to be steadfast in its support.
Walk us through the Defence Secretary pick, John Healey, also talking about the defence industry contributing to growth. Walk us through it.
Yeah, that's the point that they want to make. But a big question is, when are you going to announce when you will hit this target of spending 2.5% of GDP on defence? And we don't have that, so what's the point of a target without a deadline? He said they'll announce it in spring, but that's already nearly a year into this Labour government. It's not quite the certainty that Donald Trump or business wants. But the point of this new defence industrial strategy is to direct more defence investment into British firms like BAE Systems. So take a listen to what he said.
First, we will direct British defence investment more towards British-based businesses so we can drive jobs and growth throughout the UK. Second, we will make sure that we can innovate at a wartime pace, learning the lessons from Ukraine that tells us, look, the cycle of obsolescence can be as short as 6 weeks on the front line. And thirdly, and importantly, it's the foundation of long-term relationships, government and business working together, industry, investors, innovators. And today we're doing the first ever wargaming with industry that is looking at the challenges and decisions that we would face in government, industry would face as well, if we had to deal with conflict and some of the threats that would come from that to industry and to their supply chains.
So innovate at a wartime pace. It's hard when you've got to keep up with the likes of Israel, who are doing that on the battlefield. But by buying British, the idea is that the money goes into R&D in British firms so that they can keep up. Now, this is part of a whole relaunch of policy. We'll hear from Keir Starmer on Thursday in a big speech. They're not going to use the word reset, but of course it has been a difficult few months. They need to hit the reset button. And it comes back to the American experience. Labour is looking at the Democrats' demolition in the US and thinking you have got to deliver, you've got to make people feel like you've delivered if you had any hope of being re-elected in 5 years.
Feels like we're very early in this cycle to be talking about what happens next, but people are certainly already discussing it. They didn't win with a huge majority of the popular votes. We will see how that plays out ultimately. Even Starmer talking about that the other day. Lizzie? Great stuff. Thanks very much indeed. UK correspondent Lizzie Burden. NATO foreign ministers are meeting in Brussels today. The war in Ukraine, again, firmly in focus. This after several recent visits by European leaders to Kyiv. This as they look to show their support. For more, let's bring in Bloomberg's Oliver Crook. He joins us from Berlin. So we've had the new EU Foreign Affairs Chief and Council President in Kyiv. We've had them at the weekend. Olaf Scholz has gone now. Is Ukraine convinced that Europe's still got its back?
I think that Ukraine is convinced that Europe still has its back. I think the question is, what is that really worth in the grand scheme of things? I mean, Olaf Scholz was there in Kyiv speaking alongside Volodymyr Zelensky, the president of Ukraine, and really basically reiterating the thing that we've heard from Scholz and many European leaders since the very beginning, which is basically that Europe has staying power, it's there for the long haul, and that its support for Ukraine is unshakable. When Olaf Scholz says that, it is of course significant because Germany is the largest contributor in Europe outside of the United States to the sort of war effort in Ukraine financially and as well as military hit. But it also comes from a chancellor who has been very reticent to basically back some of the more extreme sort of means of defense that Ukraine has asked for, has not gone, for example, as far as Joe Biden in terms of long-range missiles, dragged their feet on a lot of different sort of kit, whether it was tanks or those sorts of things. And that really is sort of the bind that you now find yourself in, particularly when you consider the idea of the U.S. withdrawing. There is this sort of sense that, while the Europeans are paying for some of the gas, they're really not driving the car. And at the end of the day, there will be no replacement that can sort of live up to what the U.S. has been provided. And Zelensky himself saying a few weeks ago that basically if the U.S. were to withdraw support, even if you still had European support, that would basically mean the war would be lost for Ukraine.
And a much less certain picture then when it comes to the United States, Ollie. We're going to hear, I think, from Anthony Blinken later on. What's the message likely to be?
Yeah, so he's going to be in Brussels. This is going to be the sort of final top sort of level NATO meeting. And I expect that it's going to feel a bit like the final last meeting. I mean, we've had this sort of so-called Biden blitz over the last couple of weeks, sort of trying to rush as much support forward to Ukraine as possible. We got even more overnight from the Pentagon, $725 million package worth, even more anti-personnel mines. Of course, what we saw from Biden was to allow for those long-range missiles to strike within Russia. There was a big question about debt forgiveness of $5 billion to Ukraine, sanctions on Gazprom Bank, really trying to push all of this stuff forward in anticipation of the Trump administration, which brings a huge amount of uncertainty for Ukraine. What we did have develop on the Trump front over the last couple of days was the appointment of retired General Keith Kellogg, who has written extensively about what he would do in Ukraine. He is now the special envoy, will be the special envoy for the relationship between Ukraine and Russia and really sorting out the war. His position, what it amounts to, is basically both of these sides need to come to the negotiating table, likely a freeze of the battle lines where they are. And if either side basically refuses to come to negotiate, if Ukraine refuses, then basically that means U.S. support withdrawn. If Russia basically refuses, then that means more support to Ukraine. Again, this is not official Trump policy, but this is the person that Trump has elected and has put forward to manage this relationship, and this is what he has written in recent months and weeks.
All right, Bloomberg's Oliver Crook out of Berlin for us. We thank you so much for walking us through that crucial story. As Ollie was speaking, some news crossing the Bloomberg terminal. Redhead, Total Energies set to near a €2 billion deal for renewable project developer VSB. I think the context here is very crucial when it comes to Total's kind of strategy around the infrastructure story, because they have a lot of private capital to deploy in terms of the renewables, but they've kind of been caught up in a little bit of the red tape, getting in some heated water with the European Commission. So this perhaps forging a way to make things a little bit easier to invest in renewables, invest in already existing technology and existing infrastructure.
I think this is really great, the timing of this, because we were just having a conversation about how French corporates might be put off doing any kind of deals because of uncertainty in French policy.
I suspect this may have been a deal that's been taking quite a while to put together.
Yes. But here is Total Energies, close to acquiring VSB Group from private equity. And it does tap into what we were just discussing with Richard a moment ago about private equity under pressure to sell some of these assets. And he was saying it will come. They can't stall it forever.
Does that mean that Total's getting a good price here? Because private equity
you wonder if there's increasing pressure on private equity to sell, what kind of deals could corporate buyers get in that context? A quick reminder of some of the things coming up today. We've got a big focus on the French story, of course. We've got the French National Assembly convening, but the calm before the storm, maybe, because tomorrow is the day that we expect to get this vote of no confidence in the French government.
I'm looking for jolts. This is the big number today. We're going to get a whole bunch of Fed speakers, but the data is what we're going to be watching. Jolts are expected to actually tick higher, i.e. more job openings. A suggestion that the labour market in the United States, while that number has been trending lower, is still fairly robust. This obviously a preview to what's going to be happening in payrolls Friday.
Does the labour market still matter? Christopher Waller seems to think so, but the market reaction has been slightly more muted in the last couple of readings.
We seem to have gone back to a sort of more inflationary labour force balance. Like the dual mandate does seem to be maybe in focus, but you wonder whether the Fed actually is more interested in what happens in the labour market for obvious political reasons. We're going to be speaking to the Nasdaq presidents. That conversation is coming up. Co-presidents, I think 9:30 a.m. UK time. That wraps things up for us. This is Bloomberg.